Well, first, NYSE parent company Intercontinental Exchange, or ICE for short, released its July mortgage monitor earlier this morning, providing next-level data and insights into the housing space. Joining me now with more from Denver is Andy Walden. He's head of mortgage and housing market research for ICE. Andy, it's great to have you. I hope you had a wonderful 4th. And let's kick things off here because ICE data does reveal that there are some early signs of financial stress for some homeowners. What can you tell us, and who is most affected?
Yeah, absolutely. And I mean, overall, when you look at mortgage performance out there in the market, things remain relatively strong. The one area that does catch my eye, the number of folks that are 3 or more payments past due is up 14% from the same time last year. And it's really happening in a couple of key categories. One is FHA lending. The second is VA lending. And those are both areas of the market that tend to be lower down payment, lower credit score type of borrowers. And so folks maybe on the lower end of the income spectrum starting to feel that economic pinch, starting to see a little bit of rise in mortgage delinquencies there.
So I see annual home growth prices have slowed to just about 1.3%. Could be good news for some potential buyers. What might it mean, though, for buyers who recently purchased a home?
Yeah, certainly, depending on where you are in that home ownership spectrum, you mentioned potential home buyers. That's good news. Certainly something that they've been waiting for some time, for a little bit of affordability to move into the market. The folks that we really keep an eye on there, in terms of, kind of a focus on concern, is folks that bought at or near their local market peaks recently. So folks that bought in 2022, 2023, early 2024, especially in areas like Austin or San Antonio, Texas, or in the Gulf Coast of Florida. I mean, in Austin, home prices are down close to 20% from where they topped out over the last couple of years. And in parts of Florida, you've seen 10 to 13% pullbacks in prices in those particular areas. So it's those folks that bought in or at the peaks that can maybe find themselves in an underwater position, or folks that we have an eye on right now.
So I see that Hartford, Connecticut, that region saw more than 7% year-on-year growth when it comes to prices, followed by New York City at over 6%. Andy, what is driving these prices higher compared to regions like the Sun Belt and even in the West?
Yeah, it's a good question. You're certainly seeing a lot of variety across the country in terms of home price pressures. When you look at those areas that are seeing the strongest home price growth right now, the key is really inventory, right? And when you look at areas in Connecticut and New York, there are areas where we're still 50, 60, 70% short of where we traditionally would be in terms of the number of homes available for sale. Those are the areas that prices are firmer right now. And then you look at areas that have returned to or are above where they typically would be in terms of the number of homes available for sale. You mentioned that I'm dialing in from Denver this morning. Denver has twice as many homes available for sale as they did from 2017 to 2019, and it's a much softer price dynamic here. In fact, prices are pulling off of some of their recent peaks. And so really, when you look at the various geographies across the country, what we're seeing in terms of price dynamics, a lot of it's being driven by just simply the number of homes for sale and that inventory supply of the supply-demand dynamic.
Yeah. This July ICE Mortgage Monitor also addresses negative home equity. What does that mean, and do you think we'll see less homes for sale, Andy, as a result?
Yeah, and it's really simple, right? Negative equity is just owing more on your home than your home is worth. And we traditionally see it alongside elevated levels of inventory. The real concern there, again, when you owe more than your home is worth, is if you go through a job loss situation, if there's some reason outside of your control that you can't make your mortgage payment, now it limits your options in terms of how do you right-side yourself in that situation. And it also creates loss risk in the mortgage market for folks that have lent on that home that may need to sell that home through a distressed REO type of situation.
And more than 8% of borrowers have financed homes with ARMs or temporary buy-downs this year, according to the data. What is driving this uptick, and how can they reduce risk for higher rates once the ARM terms expire?
Sure, and I think there's a couple of different drivers behind that, right? One of them is the interest rate dynamic. If you look at what happened post-Liberation Day, you saw mortgage rates take about 1/8% leg up, and so affordability's faced a little bit more pressure in May and June than it had earlier this year, as folks are reaching for some of those more affordability-based products out there, your adjustable rate mortgages, your temporary buy-downs. The other piece on the temp buy-down side is what's going on the sell side, right? Sellers are competing with each other more. Again, as I mentioned a second ago, there's more inventory for sale than there was earlier this year. And that makes sellers a little bit more willing to give concessions and to pay for some of those temporary rate buy downs that make homeownership a little bit more attractive for buyers.
Now, according to the Monitor, nearly 20% of mortgage holders are carrying student loan debt. Is that impacting the number of delinquencies or late payments that you're seeing?
Yeah, and it certainly has the potential to. When you look at folks that are past due on their student loan payments, they can be up to 4 times as likely to be past due on their mortgage payments. And when you look at student loan delinquencies early this year, they've gone from 15%, they've almost doubled from January through March and April, up to 30%. So you almost have a third of student loan holders that are now 3 or more payments behind. And you're starting to hear more discussions and kind of the reenactment of wage garnishment and collection activity on those student loan payments. That can put pressure into the mortgage market as well. So certainly something that we'll be watching as we make our way through summer and into early fall. Do we see a spillover effect of these rising student loan delinquencies and wage garnishment on mortgage performance?
Now, we just broke down the July Mortgage Monitor. What mortgage trends do you see becoming a lead story as we move into the months of August and September, Andy?
Yeah, I see a couple that I would call out, right? One of them is kind of this movement from Florida and Texas, which have been kind of the headline states in terms of softer home price dynamics. We've started to see some leading indicators moving out west now, even out into California. Every major market in California now on pace to return to 2017 to 2019 averages of inventory by the end of this year. So perhaps a softening price dynamic going on out there in the state of California. The second one would be, how do sellers respond to this shift in housing market dynamics? When we look at 2022, 2023, when the Fed initially raised interest rates and inventory began to come back and the housing market softened up, sellers stopped listing their homes. If they couldn't get the price that they wanted, they pulled back on listing their homes for sale. That's a trend we'll be watching here over the next couple of months as well. Do we continue to see inventory rise and the housing market soften up, or do sellers grab the reins here a little bit and limit their listing activity? So those are a couple that we'll be watching as we make our way through the end of this year.
Andy Walden, head of mortgage and housing market research for ICE. Andy, thank you as always.
All right, thanks, Kristen. Appreciate you having me.